Hello and welcome to a brand new show of India Reboot, the show on which we would debate, ideate and discuss that what can be done to bring India back on the growth path. The second wave is over. Markets are at an all-time high. Economy is clearly showing signs of coming back. While the worst of the COVID behind us, and how are lenders essentially preparing themselves if, God forbid, there is a third wave. To discuss all that and much more, outlook and quarterly numbers, it gives me great pleasure to bring on board Mr. Sumant Kathpalia of IndusInd Bank. Mr. Kathpalia, fantastic to have you back on ET Now. Thank you for joining us. Mr. Kathpalia, the way I look at your quarterly numbers are in two buckets. One, absolute, and second is relative. If I look at the relative performance and compare them with peers, when the peers have struggled, HDFC Bank or ICICI Bank or even Bajaj Finance, on the retail front, you've done well. So let's understand that what have you done differently that on a relative basis you did not feel the heat of the second wave?
So Nukunj, thank you for inviting me, and yeah, I agree. I think if you look at on a relative basis, our retail businesses have performed well. And if you look at our retail basis, which is 55% of our book, 43% of our book comes from domain specializations. These domains are in vehicle finance as well as in microfinance. On the vehicle finance business, I think we've always been better. This is a business which is 30 years old with us. I think we've seen differentiated cycles. There was restructuring which was done in this book. We took a restructuring of 3,000 crores in this book, and we took a credit loss of almost about 1,000 crores over the 2 quarters in this book. So I think we have upfronted the losses, and I think if you look at this quarter also, we had 600 crores of gross outflow, but we also had a recovery of about 150 crores on that book. So I think we've been able to manage the vehicle finance. I think the part of vehicle finance which is under stress is in the three-wheeler segment and in the medium and heavy commercial vehicle, where our exposure of the total book is about 30% of the book on the vehicle finance segment. The rest of the books, which is tractors, personal vehicles, as well as have done very well for us. On the microfinance, the strength of microfinance is it's a very well diversified book, and it's a contact business. If you are able to do the contact, the efficiencies come in. And I think being diversified and being a contact business, I think we had a 640 crores outflow flow into that business, but we were able to recoup about 400 crores. We've also reinitiated, 500 crores of restructuring, which will happen this quarter on that book. But otherwise, I think we're well on our way. And I think if the COVID-3 does not play out, I think these two businesses should perform well. Trucks are already on the road. Vehicle finance is doing well. I think states have opened up, except for 3 states where I think there is a lack of opening up, which is Kerala, West Bengal and Karnataka. And Karnataka has started opening up. I think the business is doing relatively well.
Okay, now let's talk about the absolute part. On absolute basis, you are confident of a double-digit credit growth, which is substantially higher than what the industry average is. When I say industry average, the banking sector average, and what we've so far heard, let's say, from SBI chairman when he came on our show a couple of weeks ago, or what sense we've got from ICICI Bank last week. So on an absolute basis, if you are indicating to a growth which is significantly higher than others, is this largely because of your low base, or you are confident of growth coming back?
There are both the factors. I think the economy is looking up. We never expected a rebound in July the way it has happened, and it will be reflected once the data starts coming in. I think vehicle sales are back. We are seeing MFI demand coming up. We are seeing demand from the corporate coming up. So I think the demand is back as far as July is concerned. I hope it plays out and we don't have a COVID-3 which is as strong as COVID-2 which happened. On the growth part, you're absolutely right. We are coming from a very small base. Last year, our growth was just 6%. And if you look at our year-on-year growth, it has just been a very small number. If you look at where the growth will come up and our vectors of growth, I think it will come from vehicle finance, specifically the diversified portfolio which we have. And I think that's where the growth will come up. The growth will come from our microfinance business, not that much, but it will come at about 10 to 12% on our microfinance. The corporate business for the first time, it started seeing growth. We were selling down the portfolio last year, so we had a degrowth in the corporate bank, but we are now seeing the growth coming back in the corporate bank, and the SME business and the MSME business, which we had not grown over the last 1 year. I think we are seeing growth coming back, and I think we were very cautious, but I think we see the growth coming back. We've given an indication of 16 to 18% growth, and I think that translates to about 30,000 crores growth in 3 quarters, and I think we should be able to manage that.
In order to manage this kind of growth, will you be taking high risk? If I take the clock back to IndusInd Bank in the pre-INFS era, the DNA was high growth. Then INFS happened, and then you got into trouble. How will you ensure that if you grow at 16 to 18%, which is almost 1.5x than the industry, even though the base is low, you will ensure that risk is not compromised?
So I think you have to look at differently. Where did our pain come from? The pain came from large corporates, and specifically 5 corporates, which I don't want to repeat, but it's just happened, and we took extraordinary exposure in those 5 items, and they were holding promoter company exposures which we took. I think we've learned our lessons very well. And if you look at the corporate growth, will continue to be benchmarked to the market. And if you look at our growth, most of our growth is happening in A-rated paper and above, and our duration is shorter, and our ticket sizes have become very, very short in that. So we are more focused on the working capital growth. The vehicle finance and the microfinance business, or the diamond, which are 3 domains which give us the growth, never gave us the problem. And in those 3 domains, we have a market share of 15%, and I don't believe those are the domains which will give us the problem. And our growth is coming from that. Our growth will come from the MSME segment, where we have a 2.1 market share. We want to go to 6% market share over a period of planning cycle 5. And the growth will come in the SME segment, where we've opened a new segment which is between 100 and 500 crores, where our book is very small, and our growth will come from there. So we are focused on these 2. We've also added some accelerators into our growth, and those accelerators are the merchant acquiring business, which is an offshoot of the Bharat Financial business, where we believe across the spectrum of the country, which is either in urban, rural, as well as in the semi-urban, we want to do merchant acquiring. We already have 2 lakh merchants which we've acquired under this. We have a 400 crore book. This year we should end up at about 1,500 to 2,000. Next year it should be a 4,000 crore book. It's a book which gives us 23% yield and is government guaranteed up to 60% of the book. If you look at the other book, which is affordable housing, we've been slowly growing this book. We are sitting on 1,800 crores of book. The clients are with us, and it's a cross-sell into our client base. And we believe that we can create another 6,000 crore of book in the next 2 years. So our growth is coming from existing businesses as well as new verticals which we've added. We have not grown our unsecured book. So the unsecured book, which is credit cards and PL, is less than 5%. It's actually 3.5% of our book. And we don't believe that we will continue to grow that book. We are very focused on calibrated growth, and we are very focused on making sure that the risk density of our growth remains within range bound, range bound.
Okay, fair point. Let's go to the other layer, ROA. ROA, just for the benefit of our viewers, is important to understand the bank's profitability. And ROA, sir, is a function of credit cost. Let's understand where your credit cost is, what's happening to the liability franchise, and where do you see ROA will eventually settle. I'm throwing 3 questions into one.
So let me answer the reverse way. And I think that that's a very important question. And I think when I came in, there were 2 issues on the balance sheet, and both the sides of the balance sheet had an issue. So we had a liability side of the issue, and we had an asset side of an issue. On the liability side, we've really worked very hard, and I think and the results are there for everybody to see. We have grown our liability business by 26% year on year. We've grown the CASA by 33% year on year, and the retail deposits, most importantly, by 57% year on year. What is more important is, as per Basel III norm, which is in public figure, which was 29% for us, has moved up to 41%. And I think that was a big jump which we expected. Number two, if you look at our net interest margin, we've been range bound on our net interest margin. We were lower this quarter at 4.06. Otherwise, we've been in range bound between 4.15 to 4.25. We've always said that we will continue to be range bound. We will not grow that margin. However, we had excess liquidity of 54,000 in our books today, and as a consequence, we lost out on our NIM. It was not on the asset side or the deposit side cost of deposit. It was actually because of excess liquidity. Our PPOP margins at 6% are amongst the highest in the industry, and if you look at the overall asset, it's about 3.67, which is almost highest in the industry. We believe that because of the portfolios which we have, we will be able to maintain our PPOP margins. So I think given that the PPOP margins we have are very high, I think our ability to absorb shocks of this nature was there. Of course, our ROA suffered, but if you see the normalization of credit cost happening, and we have taken upfront provisions a lot, and we carry 2,050 crores of excess provisions in our book, and also we are 72% PCR. I think we should be able to normalize the credit cost between 160 to 190 basis points this year. And I think you can compute the ROA as a consequence of that. We believe that our ROA at certain point, once our credit cost normalizes, and if the COVID-3 should be in the range of 1.7 to 2% at any point of time.
Mr. Kathpalia, even though you've alluded to this point, I'm just going to revisit this aspect so that at least we don't get it wrong and our viewers and your investors don't get it wrong. I'm going to break IndusInd Bank into three parts. 2015 to or 2014 to 2018, before the IL&FS crisis. That was high growth balance sheet expansion phase for IndusInd Bank, where you did exceptionally well. Then came the current patch, which is you started contracting your balance sheet because of IL&FS and the 5 corporate accounts. Are you likely to go back to the corporate expansion mode, which is what you followed in 2014 and 2018? Because that changes the complete DNA and approach of the bank.
See, to say a corporate franchise was wrong, I think will be very incorrect. I think our corporate franchise did very well. What the issue was, I think between 2017 and 18, we took some exposures which were higher than what our balance sheet could have taken. And I think, unfortunately, those went wrong. And I agree with that, and we've already admitted to that. But to say we will not grow a corporate franchise will be incorrect. We have a very good products, we have a very good team, and we have marquee relationships with us. And I think if we balance the working capital and the term loan and capabilities, and we do the corporate bank right, I think it will contribute to maybe 42 to 45% of our assets. I think the retail side of our balance sheet and the MSME side of the balance sheet will be around 55 to 58% of our balance sheet. And I think that's where we have domain specializations of a very different nature. And I think we will grow that. In addition, there are two new vectors which have been added. One is the microfinance, the merchant acquiring, and the other is the affordable housing to take care of it. We are also cautious that we need to add a fourth domain. We are evaluating a fourth domain. And I think we will add a fourth domain, which will give us specific lift to the balance sheet over the next 2 years. So I think we are not changing our tax. We become more conservative and prudent in the way we do underwriting in the corporate side. Where our domain specializations are, we will continue to maintain market share, and we are adding new domains to make sure that we keep ahead of the pace. A lot of people say large banks will consolidate and large banks will survive. I tend to agree. We are large banks in the 3 domains, and if we are adding a 4th domain, we will continue to be a large bank, and we are different in that nature from the other banks, that our domains is what gives us the growth and value creation.
You are a market leader in the diamond business by design and by acquisition. Your historical business, which is the auto finance business, again you got leadership position. What could be the fourth domain where it is a large high growth area where a bank of your size will be able to have a meaningful impact?
So we are evaluating multiple areas, Nikunj. It will be unfair for me to tell you because it's highly sensitive, that information. But yes, it will be in an area where we will create 11 to 12% market share. For us, a market share means that we are number one or number two in that leader. If you look at our vehicle finance, we are at 13% market share in all the vehicles which we operate. If you look at MFI, we have a 13.5% market share. If you look at diamond, we have 25% market share. So I think we are not going to add a domain just unnecessarily by adding a domain. So it will be a domain where we get a strategic market share. As a consequence of market share, we get client loyalty, ability, pricing power, as well as collection efficiency. So I think those are the areas where we are focused on, and you will see an announcement in the market domain space in times to come.
Okay. Why don't you clear the air on Vodafone? What kind of provisioning you've done? And why I'm asking you this question is that every time something happens to the Vodafone stock, there is a direct correlation to IndusInd Bank stock. So markets sometimes overreact. So let's revisit it.
So let's understand, and we've been very vocal about it. We have an inordinate high exposure of 3,450 crores on Vodafone. And we have 990 crores in funded and 2,400 crores in non-funded as a consequence of that. Let's understand what this Vodafone exposure is. The Vodafone exposure on 990 is where we are very comfortable on our provisions, and the 2,050 crores of extra provision which we have taken covers it. And what we will do in the next quarter, we'll specifically allocate to a specific exposure on telecom, which we will do it because we have created segment exposure where we have 150 crores of exposure provisions which we are creating. We'll add 700 crores into that so that the market on the funded exposure will keep quiet that we have done the provision. On the non-funded exposure, I think we have to see how the progress happens in this. And we have to evaluate. I don't think guarantees will be invoked because this is a running organization with a 26 crore client base, subscriber base. We have to see how it flows, and if there is a requirement, I can assure the market that we will be very conservative in our provision, and we will take the provision upfront rather than deferring it over 8 quarters. We have enough PPOP in our wallet to make sure that we take the provision upfront on our chin, and rather than spreading it across 6 quarters or 8 quarters.
Okay. And that entire provision, if you have to take, I'm not saying you're taking it, if you have to take, if things don't work out for Vodafone, would be 2,500 crore, just to understand the number.
The provision, see, don't expect that the provision, I have enough contingency provisions in my wallet. Yes, if I take 800 crores or 900 crores next quarter as a provision, which it is a balance sheet item which I will do, I will have 2,500 crores left, which I will take once we know what the progress is happening. It is on the guarantee. The guarantees have to be invoked, and the guarantees invoked doesn't happen immediately. It happens up till March 23. So it's not that it will come in one day.
Compliment to you, Mr. Kathpalia. You've been very frank and you've been very forthright, and even though I'm trying to throw all difficult questions at you, you're honestly answering them. So really, appreciate that. But I'm not done with questions. My next question perhaps is more like a big picture question. I'm looking at your numbers. Your pre-provisioning profit of the assets are at about 3.5, 3.6%. Can I say that gives you necessary and enough elbow room,
3.67.
even if there is a third wave, or even if 3.67, there you go, I had 3.6. So 3.67 means that you have a lot of cushion.
I believe that's the strength of this organization, and that's the strength of the domain businesses which we have got. Nikunj. And I believe that our provision PPOP margins are such that we can take any provisions right now. I don't believe that the third wave will be as vigorous as what we saw in the COVID-2 or COVID-1. In fact, the COVID-2 impact was much lesser on the portfolios as well as on the business as COVID-1 was. And I think the COVID-3 with the vaccination happening will be much lesser in impact than COVID-2. So I think we have to be positive about our businesses. And I think if there is a requirement, we will take the provisions upfront like we've done, and we've kept excess provisions. And I think that is something which we can give you a commitment that we will not shy away from taking provisions upfront.
So, Mr. Kathpalia, a bank of your size, no presence in the typical fee-based pockets, which is AMC, a big brokerage, or for that matter, anything which has got to do with insurance as a manufacturer. I know you're trying to follow different strategy by focusing on diamond business, adding a new fourth domain, focusing on diamond vertical. But ultimately, banking for a retail customer has to be an experience. How do you defend that?
So, very valid question, and we've been asking this question to ourselves. We definitely wanted to be in para-banking activities. And I think brokerage, non-life, and AMC are upper stream because we are very, very large distributors of these three products. And I think there is a time when you evaluate whether you want to manufacture or you want to become a distributor. I think we want to become a manufacturer in this. Unfortunately, the holding company guidelines are still coming out and the tax implications are not clear right now. Once we get that clarity, I think we will get on with that thing. But what you will see is, I think in some of these areas, we will take a necessary stake to which is allowed by the RBI, which is about 10 to 20%, and we will take that stake to announce our thing that we want to be in that business. If you look at how are we going to compete with the market, I think there are different ways to compete with the market. I think digital is the next foray in how you will compete with the market. I think we are getting into 5 specific areas where we believe we can differentiate ourselves against the rest on the digital area. And you got to have a differentiated proposition. We have a domain expertise in vehicle finance. We are going to launch a differentiated vehicle finance offering in our digital place aligned with the marketplace. So I think, and specifically in the used car place, and you will see a very differentiated offering coming in the next 6 to 9 months. The second area where we think we can make is the merchant acquiring business. And I think we are not focused on the large merchants. We are focused on merchants where our Bharat Finance stores can manage it. So we have a Bharat Finance stores. We've already got 100,000 stores. We'll go to 500,000 stores, and we will have 2 million merchants by the end of 2 years. We will create a very differentiated proposition and a capability in the Bharat Finance stores. The number 3 in the merchant acquiring, The third business where we think we can make a very good is on the SME segment. And you will see us launching a very differentiated stack on the SME segment in the 6 to 12 months. And we are working on it. It will be segment specific, aligned to marketplaces as a consequence of this. The fourth is the individual segment. And I think we are coming with a very differentiated payment as well as lending stack and lifestyle capability building, where the lending stack will align with the best in breed of capability building, for example, in insurance, for example, in the brokerage, for example, in AMCs. So I think the client will have the capability of getting all these benefits along with a very differentiated stack and experience on the payments as well as on lifestyle benefits. So I think that's on the fourth side. And the fifth, which I think is we've already launched, which a portal as part of a digital on the credit card and personal loan, where it's a micro-based, API-based capability which we built it. And I think It can be used by clients, it can be used by our partners, it can be used by our employees, and I think it's a very differentiated, and we have reduced the cost of processing by 80 to 85% as a consequence of that. So I think when everybody talks about how you will differentiate yourself, we're creating a very differentiated digital stack offering. It will run under a separate brand, a separate piece altogether once we finished our digital stack capability. And I think you will have two types of bank. One is the traditional bank, which will focus on domains. The other is the digital bank, which will create a BU within the bank, which is a digital bank, which will create on a very differentiated offerings.
So what are we looking at? I mean, walking on the lines of HDFC Bank, where you create a platform, or walking on the lines of SBI, where they've incubated a YONO?
See, I think it's a mix of both which will work, in my opinion. I think you can't do digital working on traditional platform and create a user experience. I think there are two things which will distinguish us from in the digital foray. One is you have to be there where the client is. Don't necessarily believe the client will walk into your site or to your branch. I think that's passé. That's number one. The number two differentiated is you have to be obsessed with the client experience and user interface. And I think if you get these two rights, I think you will get it. It will require reorientation of technology platform, maybe replacement of some of them. And I think that is where digital will come in. It's a replacement of the technology platform, and it's how you hybrid it with your existing branches in some way, so that you have the advantage of your brand distribution as well as the digital capability in the long run.
Mr. Kathpalia, there is a zing in your voice. Haven't used this phrase. IndusInd Bank, kya अच्छे दिन वापस आ गए? Haven't used this line अच्छे दिन in a while, sir.
Nukunj, I think there is a timing and there is a phase and a cycle for every business to go through. I think we've gone through a tough cycle. I think we've emerged stronger. We've emerged much more resilient. And I think we will give back to our shareholders and our stakeholders what this bank is supposed to be. And I think we are positioned for growth now.
Okay. So I'll conclude our today's interaction that अच्छे दिन वापस आ गए, and later in the day we'll also play an excerpt of our conversation with Mr. GP Hinduja, where he does feel and is excited about the kind of good work you are doing. He will play a part of this conversation also. Appreciate your time, stay safe, and certainly hope to see much more of you going forward.
Thank you.